Hey everyone, I want to welcome you to this week's episode of the HX podcast. Today we have an old friend of mine, Carol Roth Schneiderman. Do you still use Schneiderman? I don't know.
No, so I don't, because I had a 12-letter last name, and I told everyone I was going to marry someone with a 4-letter last name, so it's Roth. And by the way, Enrique, I am a longtime friend of yours. I am not an old friend of yours. Thank you very much.
Oh, I know. You corrected me. You corrected me on this before. I apologize. Carol and I have known each other for 30-some years. We're very happy to have Carol here today. Carol's got an incredibly diverse background. As she likes to say, she's a recovering investment banker. She's a 2-time New York Times best-selling author. She's published a number of books. Carol and I, went to school together. But what I've really been blown away with what Carol's done is she's taken on a number of topics and really pushed them forward, especially defending small business and trying to understand, some of the predicaments that we are facing in our economy as individuals and, again, as small businesses are facing. So what we're going to do today, I want to jump in and just talk a little bit about what you're seeing out there in the world today. But Carol has some really interesting insights on what's happening and where it may go, because I think there's a lot of things that are developing today that are going to have ramifications for years and years. So, Carol, let's just jump into it. Tell us what's got you interested right now at the moment.
Got me banging my head against the wall. Certainly, right now, it's the unsustainable, catastrophic fiscal trajectory of the United States. We are in a position where we have more than $34 trillion in debt. Our debt to GDP is in a range that if we were an emerging market and we didn't hold the world's reserve currency, we would be in a currency crisis right now. We have deficits to GDP. They're about 2 times the historic average. And what's so unusual, as I'm sure you know, Enrique, is that normally in times of growth, that would shrink the deficit. We have the opposite effect going on right now, where the expanding deficits have been used to window dress this illusion of growth, which is obviously something that can only happen for a little bit of time. Personal balance sheets are being decimated. Personal saving rate is down. Personal debt, household debt is up. It's just a really tough trajectory. We have everyone and their brother who has said at this point that this is unsustainable, and yet nobody who's been willing to do anything about it. And as this sort of relates to our market discussions, I think that has ramifications for both fiscal and monetary policy that loop back around into the markets and make only a certain sort of set of, sort of outcomes happen. And I think that's sort of very relevant to thinking about how the future is going to potentially look perhaps different than the past.
Okay, so let's do this. This is very similar to a conversation we had last week with a gentleman named Eric Wade. And he had different groups of topics, but they were very, what I would call these big elemental truths that he was going through. That I didn't disagree with the conclusion of any of them.
Yeah.
But there's a long way between here and there. So I want to go in and we're going to very actively unpack a bunch of things you said, but I may jump to some of the conclusions in the middle of this.
That's good. I've known you for a long time, as you said. So this is not an unusual way our conversations unfold, right?
Well. And let me just say something too, is a bunch of the things that you said, which I do fundamentally agree with, they're not completely out of left field. They're not, it's not like AI, which AI existed. No one was talking about AI.
Right.
People have been talking about these topics. So let's go to the first one of these, because you said it right out of the gates. If we weren't the reserve currency, okay? Because I think that when you look at our deficits to GDP, which I want to come back to that one in a second, if we certainly look at our deficits, if we weren't the reserve currency, we'd have a lot of issues. But we are the reserve currency. What do you think, and this will kind of get to, I'm going to go all the way to the conclusion, which might be the opposite of the way other people do this. What breaks this? We know we've got big deficits. We know we've got big spending. We know it's quote unquote unsustainable, but it seems to be pretty sustainable right now? I mean, what is the equation that finally breaks this?
Well, I would argue that it's not sustainable, and that we have seen a lot of Band-Aid fixes that have happened. The Fed has intervened with lots of different programs under cute little names, whether it's their repo programs or their bank programs or whatever the different acronyms are. But we've had many times when the Treasury market was about to puke, or that we've been on sort of the precipice of a crisis that really starts to implode things, and we've got a lot of sticking our fingers in the dam. The multi-trillion-dollar question is, when does the dam actually break? If I could tell you that date with specificity, I would be sitting on a super yacht in the Mediterranean right now and not having this lovely conversation with you. But we can see that we're getting closer and closer to that, and that the rate of acceleration is increasing, and that something will have to happen, and that something is probably unpleasant and has lots of repercussions. So I think that when we kind of look at the context, it's about positioning yourself, because I know you like actionable conclusions, in a very diversified manner, because there are several paths that this could take, even though I personally think some are more likely than the others. And I also think, just given, if you look at the trajectory that we're on and the reality of the situation, and what things look like today, what the Fed policy is today with 120% debt to GDP is very different than Volcker's policy was when we had a fraction of that, debt to GDP, owning hard assets, that the possibility for the Fed to come back to an accommodative policy and to continue to try to inflate their way out of this situation, I personally think, and we can get into it, is a most likely outcome here, which I think on a at least nominal basis, bodes well for people who own more things, and the people who aren't, who are on the sidelines and putting their head in the sand and trying to figure out and time things perfectly, may find themselves left behind.
Okay, so I'm going to take a step back too, because it's funny, is I think our podcast has probably a group of listeners that are very sophisticated with financial terms and the actions of the Fed, liquidity, et cetera. And then we have a group that are, frankly, real people,
yes.
Doing real things.
Doing important normal work and not the stupid financialization stuff, yes.
Yeah, doing things that actually make the world function and everyday stuff. So yes, exactly. And that's honestly who we're primarily written for.
Yes.
It's funny is with my newsletter, the conclusions are the same actions I would tell the most sophisticated institutional investor in the world, but instead of giving 74 graphs of data, I'm like, well, here's the 3 things why this is really happening, and kind of focus on that.
Yeah, and that's why you and I are always aligned too, because that's sort of what I'm known for. Some people like to call me an economist. I am not an economist, folks. I don't want to be an economist. They can't find their way out of a paper bag. I'm an economic explainer, so I try to take.
I was going to say explainer.
Yes,
that's so
yeah,
funny.
I try to take these opaque concepts and make them, as palatable and understandable, even though some of them are insane, as possible. So we're on the same page there.
I'm going to recast what you said.
Okay.
What you said, let's put it in language with the guy who's coming to paint my house in a couple weeks. The U.S. is spending more money than it generates.
Correct.
From taxes.
Correct.
And therefore we have a very large debt. The same way that if I went out to dinner every night and partied and all that stuff and didn't bring enough income, I'd end up with this big debt. So, and that debt's at $34 trillion. So far, the world is willing to basically give us this debt for numerous reasons. Mostly we're the reserve currency, but the way the whole global economic system works is it's kind of hard to call in the chit when you're the largest economy involved with the most exports and the most imports.
I'm going to asterisk that one, but we'll come back to it. Go ahead.
Okay. But again, this is going to come back to, because when I said sustainable, I wasn't saying it was sustainable. What I was saying was it might be sustainable for longer than people think. And it has been, by the way, because if I would have told you we were going to 34 trillion of debt, which, by the way, I think is doubled in like 2 years, 3 years, whatever. Okay, 10 years.
17 trillion to 34 trillion, I think, has been in the last decade. Yeah.
But I feel like it's going to double again in the next 3 based on what's happening.
Well, they said the CBO just came out with their projection. They're projecting, and again, this is based on everything working the way it's planned. So this is very conservative. 54 trillion in the next 10 years is where we're going to be at. So it's another 20 trillion in the next 10 years. So yeah, we could probably guess that we're probably doubled in the next 10 years.
Okay. But I'm going to posit something. I guess, and again, I hate going all the way to the conclusion. I think some of the things you would recommend are things that'll work no matter what, okay? But if we just went from 17 to 34 in 10 years, going from 34 to 68 in the next 10 years, who cares? What's gonna make the difference? Like, we're not saying 168. We're not saying 1068. What's to say that in that next 10 years that we can't do that again? And one other thing you mentioned, us putting the dike in the crisis, our fingers in the dam of every crisis. I look at it right now and I say what the Fed just did is give themselves another 500 basis points to cut on the next crisis. And I'm not a Pollyanna, by the way. I made most of my money in down markets. But what are your thoughts on those two topics? Why not 68 trillion? And didn't the Fed just reload the liquidity gun for the next crisis?
Right. Well, it all comes back to what that means in context, right? So we'll throw out numbers. $34 trillion for the United States holding the reserve currency would be very different than $34 trillion for Canada, let's say. So it's all
what is it? Do you know off the top, and this is a real question, not a leading one, do you know what off the top of your head what the next largest national debt is? Or is there one? Actually, where is Japan? Is it larger than the US?
I would say Japan on a debt to GDP basis, I think, is higher than us.
How about on an absolute basis? Do you know off the top of your head? You might not.
I would say on an absolute basis, I don't think anybody has more debt than we do, right?
I'm gonna look it up.
Yeah, I mean, I can't imagine, given the size of the economy and where we stand in the world, that anybody on an absolute basis. But again, absolute doesn't really matter. What matters as a function of GDP, how much we can handle. And there has been a long tenor, if you believe what sort of the breaking points are of where things really kind of get out of control. The IMF and other entities have always said that that's in sort of the 60 to 70 or maybe 70 to 80% of GDP range. So part of this is about productivity, right? If we had a very productive, fantastic economy, something happened, AI, let's say, accelerated productivity in a very meaningful way, then that changes what our debt looks like and how we're able to handle it and what that means in terms of our deficits, because that's really part of the issue too, right? Is that we have to be able to make sure that we can pay for all of the debt. So as you said... Go ahead.
Can I give you some data? No. It's interesting because I hadn't looked at this. This is how these conversations go. The largest. This is from a couple years ago. So, but not very much. This has the U.S. at 29.5 trillion, Japan at 13 trillion, China at 10, then France at 3.
Right.
It's way below there. But interestingly enough, at debt to GDP, Japan's at 255. Right. And the U.S. is at 123, and I'm guessing, and there's a couple countries, Greece, Italy, Spain,
other economies that we all go, oh my God, they're always in crisis, and that's why again.
Yeah.
So again, this
but Japan's at 255. Couldn't we go to 255? I mean, I feel like we got a better economy than Japan. That means we could do another doubling from here.
You've heard the economy. So we're not going to have a discussion about the Japanese economy today, but you have heard the economists say, right, that there's like 4 kinds of economies in the world. There are those that are growing. There are those that are evolved. Those are emerging. There's Japan and there's Argentina. So we just put those to the side. And we're just not going to say we're not Japan, okay? So, but kind of going back to our situation here. So we're in a situation where we're running the deficit last year was actually $2 trillion. I know it was reported at 1.7 trillion, but there was an accounting adjustment. It was technically they spent $2 trillion more than they took in. So we don't have to go into that, but it was related to student loan write-offs and the like. And so, they only have so many levers that they can pull. right? In order to do that, in order to get things sort of back on track, if they want to finance that deficit, you could finance the deficit by, I guess, selling off some of our assets. We choose not to do that. We choose to do that with debt. Or they could make sure we have a smaller or no deficit, and that would require increasing tax revenue. And some people, when they think increasing tax revenue, they think it means increasing the tax rate. But those of us who know economics know that doesn't always work, that often when you increase the tax rate, it actually slows down the economy and you have less in the way of receipts. So they need to make sure, both from an economy and, by the way, a stock market standpoint, because capital gains is a big piece of what they're taking in terms of revenue, they need to maximize the dollars that are coming in, right? Then they have the amount they're spending. And most of that is between entitlement and taxes, or interest on the debt right now. So we know
what is the interest on the debt right now? I mean, I guess I could
$1
just do $34 trillion.
$1 trillion. Okay. Yeah. So it's this year.
3% on $34 trillion ain't that bad. I don't know.
It's the 34 trillion piece, and then it's increasing. But we'll get to that. So, they're not going to change entitlements because that is politically unpopular, or at least do it in a way that's meaningful enough. So that leaves them with this amount of debt that needs to be financed. So here's the problem. This kind of goes back to what you were talking about, is that not only who's going to buy that debt, but who's going to buy that debt at a rate that still allows the Treasury market to function and doesn't put us into a debt spiral. And what the interesting thing that I've learned, and one of the great people, I don't know if you know Luke Groman, but he does a really great job of taking in a lot of these numbers. But he said, up until 2014, that central banks around the world basically financed of the deficit. I think it was somewhere in the range of 55%. Between 2014 and 2024, the last 10 years, that we have added $17 trillion in debt, and on net, central banks have had negative $100 billion. So they have sold $100 billion. So these wonderful central banks around the world, who on net used to be these buyers of treasuries, are not buying them anymore. So who's buying them?
You're right.
Right.
Yeah, go ahead.
The banks are buying them, pension funds to some extent, some of these foreign buyers. And then, of course, as we know what happened during COVID, it's the Fed and the Treasury. And that is the issue, is that who is going to, as we continue to blow up these huge deficits, we're going to add another $20 trillion. This is the question that I think you were trying to get to, Enrique, is who's going to buy this at what price? And if you go through, I'm going to jump to the conclusion now. The likely buyer, when all is said and done, at that level of debt and the pricing we're talking about, is going to be the Fed, the Treasury, which means we're going to be printing money, which means in their choice of whether they're going to save the banking system and save the Treasury markets and ensure the stability, or they're going to let inflation run hot, they're going to pick the former. They're not going to, they're going to say, sorry, inflation, we tried, whatever. And that's kind of my thesis as to why we are going to see ongoing inflation, which is going to continue to push up asset values in the long term. Not to say that there's not going to be some pullbacks and whatever in the short midterm, but that's going to continue to push up asset values, including things like stock and including houses and things like that. And the people who aren't making the investments are going to be left behind because they're going to inflate their way out, or at least try for as long as they can, buy as much time as they can by using basically monetization.
Okay. So again, I'm gonna take. Well, I want to. There's another interesting piece here that I will say this. I have been, and I still am, a very big proponent of the strong dollar. The dollar is the dollar is literally the representation of the reserve currency,
right? And
it has performed incredible, very contrary to your thesis.
Well, and it's actually so. But that's actually the root of the problem, right? Is that the fact that the dollar is so strong, and so that when these countries who have to buy food and other commodities in dollars, what are they going to sell? they're going to be selling Treasury. So those two kind of things stand at odds with each other.
And what I was going to say, though, is I do think that what we've seen happen with Russia and Iran here, we are beginning. I don't know. We might only be in the first inning, honestly. That's how early it is still. But the first inning of a global currency regime away from the dollar finally being established. It might take 50 years. I mean, I guess that's kind of probably where you and I will come to, where you and I have a couple differences. A lot of our strategies are what I call surfing strategies. So we're just looking for waves, big waves, little waves, choppy waves. We know how to surf all of them. Our long-term strategies are probably more aligned. I feel like a lot of this stuff, I feel like everything you're saying is true, but I got 30 good years left on this planet. I don't know if any of it's going to happen in those 30 years. But that's the thing,
it is happening. And that's the challenge, is that you have more, for the first time ever, you have more and more oil that's being settled in yuan than before it was settled 100% in dollars. We just had an administration that weaponized the U.S. dollar to the extreme when they froze Russia's reserve currencies, back in 2021 after Russia invaded Ukraine. Now the G7 talk is, can they seize those assets legally and just turn them over to Ukraine? That's going to accelerate these issues. And then I think your point is exactly, part of what's bringing this about and is going to continue. To the extent that the dollar continues to remain strong and these other countries, particularly China, are trying to, assert it, not collapse their economies, let's just call it for what it is, I think there is going to be more and more desire to look for ways around that. And again, it's our own fault, right? It's the Fed's fault for not keeping the currency stable, both for the domestic and the international economy. It's the shenanigans, it's the weaponization of the dollar. So the call's coming from inside the house. This is the U.S.'s problem, but I do think that facilitates a sea change. And that doesn't mean that there won't be a dollar. I think some people think that, it's like, Carol's saying the dollar's going away. I'm not saying that at all. What I'm saying is it's going to change the tenor, and it's also going to change the tricks. Like the Fed and the Treasury, they have so many little tricks that they continue to run, and like at some point, they just sort of run out of them. And I think that we're just seeing the acceleration of that happening. And unless we see Washington get very serious from a fiscal standpoint to shift this, or we get people who are incredibly productive, or we get a complete change in demographics, which, you could argue this migrant crisis, that's the, kind of unwritten rule, behind these people who I personally think are invaders who've breached the borders illegally. But part of it might be, hey, we need to rebalance the demographics in order to, make this sustainable at all.
Well, I think that our probably where we differ is, I agree with everything. I think that the productivity plus the immigration, and I think I'm probably where you are. Maybe we'll see. I'm a massive fan, or I'm a fan of massive legalized immigration.
Yes, you and I are aligned.
I would go, let's bring in 5 million people a year. Let's just do it legally,
legally, and make sure with people who have aligned values, who have great skills, who can fit in the right places.
Around it.
Exactly.
Well, and even if they don't have the skills, put them in the military for 2 years, like whatever. But just let's have a plan.
As long as the values are aligned and they haven't broken a law to enter the country to begin with.
So, but here's my point. But then I want to talk about my buddy Randy. Okay, we're going to come back to Randy in a second. Is that I feel like the fact that we are where we are, that 34 could go to 54, the fact that we do have productivity gains, the fact that we do have immigration, I just feel like this could take a long time. But let's talk about Randy.
Well, but before we do that, before we get to Randy's, but let's just say, I think where you and I may agree is that what it probably means in the shorter term, because we didn't even touch on the commercial real estate issue and some of the other cracks in the system, is that the Fed is probably one way or another going to be forced into a more accommodative stance. Not as soon as like everybody thought the 7 rates cuts this year, but sooner than I think a lot of people appreciate. And I do think that is going to be bullish for stocks and for, again, hard assets.
Well, it's funny. So people, I publish my daily, and my daily on Friday this week is going to come out. I spoke with a buddy of mine that went to school with us. I won't name him, but he runs a commercial real estate business, has billions and billions, and he's been doing it for 30 years. And he basically, I'll tell you what he said about commercial real estate, because it's very interesting.
Okay.
Because I think that right now, if I were to go to the financial media and say, what's the bullet that's going to hit? A lot of them would say commercial real estate is going to be the next crisis. He said the following. He goes, and I'm just going to share this, and then I want to talk about Randy. Okay,
and then I'm going to share a piece of gossip on commercial real estate too. So go ahead. Randy will eventually get here.
He goes, look, right now the market is very stuck, was his words. And what he said was, he goes, there's a very large group of private equity money. There's trillions, literally, waiting to buy the commercial real estate. But what happened is that the banks and the sellers were sitting there and saying a bunch of rate cuts are coming. Now, they had thought 6, mostly because it was wishful thinking. I always thought 6 or 7 was fucking nuts. Like, I thought a few makes sense, which is more like what happened in the 90s, where back in the 90s, I wrote a note about this 2 weeks ago, is that we didn't go from 0 to 5 to 0 to 5 to 0 to 5. We went from 4.25 to 5.25, and then we went to 4.5. Anyway, his point was the market's not moving, but his big point was this. A couple issues. He said, number one, he goes, you got to understand the counterparty on this are the banks. And it's in their best interest to not, they don't want to own this property. They got nothing to do with this property. So unless the loan is crazy out of whack, they're not going to do anything. So there's lots of buyers underneath. Let me finish here. And, and so his view was there's problems out there, but, with absent a major economic hit or exogenous shock, which could happen, September 11th happened, Ukraine happened to a certain extent, he just didn't really think, and he's doing this every day. He's literally sitting there with $2 billion waiting to buy these loans. And he doesn't see it happening anytime soon.
There was a piece that came out, I believe it was in Financial Times, and a bunch of places picked it up. There's a Business Insider article I can send to you for your listeners in your newsletter if you want afterwards. But it sounds like part of the problem, this is where all this stuff gets really interconnected, is the bank reserves. That basically that there is a floor on what the banks can take, because if they end up selling for too much, they're going to hit a loss that exceeds is the right way to say it, their bank reserve allowance. And because we have all of this problem with the shenanigans, as we know, that the banks got themselves into with their reserves because of this wild whipsaw and rates that for some reason not only they couldn't see coming, but I think in many ways the Fed kind of forced down their throat because nobody else wants to buy their stupid debt. I think that's part of what's creating the problem. And I did get a note from somebody that I trusted. And so again, this is just gossip, but we'll just go ahead and share it now. But basically, there is a very well-known bank analyst who had some insight from the Fed. And he said that they are already discussing having some sort of a GSE, like a Freddie Mac or Fannie Mae for commercial real estate to stuff things into because they believe a crisis is coming. So that doesn't mean, they could just be being prudent, but like there's enough with all of these kinds of things. And that article, by the way, in FT and Business Insider said that there's like $700 billion, I think, to $1 trillion that is potentially at risk here, or maybe that was in my note from somebody.
That's like a couple of weeks of national debt.
Yeah,
come on,
I'm just saying. So this is all. I think the point is this is all interrelated, and as soon as you get this one thing, you end up running into these other issues that have been created by this absolute complete abomination of what they've done to our financial system, this movement away from free market capitalism and making, monetary and fiscal policy the center of the universe. And I just think that's that could be a catalyst. But by the way, they said that wouldn't happen. They wouldn't put in one of these GSE types of things until there's a crisis.
Yeah, and
the time frame on that was within 1 to 2 years. So
okay. I don't know that I disagree with that, but I also think they're getting it. So let's talk about Randy.
Let's talk about Randy.
Randy, he's one of my readers. He made his money. I believe he owned a chain of Midas franchises and did Meineke or Midas or
mufflers,
one of those.
right?
Mufflers, yeah. And he did very, very well. And I think he started with one. I don't remember his background, like how he got into it. But I think he used to change mufflers, to be honest. And then he built it up into a chain, 2, 3, 5, 8 of them, and then sold them.
Great.
And then made some nice money. And then Randy's actually got out and bought some ranch land. Okay.
Nice.
And I think he's doing pretty well with that. And Randy's not our prototypical a reader and viewer. I mean, I think Randy's done quite well, probably better than most. But he encapsulates kind of two groups of people that I think are interesting. There's the original Randy who owned a handful of Midas franchises,
right.
And there's now the Randy who is sitting on a pool of wealth that he worked very hard to get. In his case, he's put it into ranch land, which I think is functioning ranch land and all that. How does this situation? We're going to take two time frames. In the next 6 to 12 months, and in the next 6 years, let's take those two versions of Randy. How does your world intersect with Randy 1 and Randy 2? And kind of walk, because I think Randy 1 and Randy 2 reflect a lot of our readers, right? People who have operating businesses, who are small business owners, working out there. And then people that have assets that have worked very hard for them. It's probably two demographics, right? The 45-year-old and the 65-year-old.
Right.
How does your world intersect with them, and what do they do about it?
Yeah, so this is why I'm a long-term investor and you're a trader, is that, I'm more
I do both.
Yeah,
I do both.
But from a duration standpoint, I'm not looking at necessarily day to day. I'm looking at very long-term, kind of things. So in 6 to 12 months, I mean, who knows? Things could happen. I think that the sort of panoply of potential issues is that we do get one of these crises that pop up, or that we end up with something that jiggles something that looks a little bit like a recession, or something that makes the treasury market break, and that creates some short-term drama. I think that probably works itself out, but particularly if you're the small business owner, you want to make sure that you have, and frankly an individual too, the emergency fund is, how am I going to be able to, if things get wonky for 6, 12 months here, maybe even 18 months, how am I going to be able to make it through? I think in terms of the longer term, from that business perspective.
Can I take a step back? Because I do want to, I'm sorry to get off track, but we're going to split the world into two. Do you remember a year ago, and I'm going to write about this a lot in the next couple of weeks, a year ago, everyone was focused on taking all of their checking accounts and moving them to 6 different banks. I only say that because I haven't thought about that concept I didn't do it. We can get into the whole conversation. But a year ago, everyone was talking about, you're a small business owner. You can't have more than $250,000 in any one bank. You need to have it in a half a dozen banks.
I don't think we're out, but that's what I'm saying. I don't think we're out of that yet.
Oh,
being
I
in issues.
I understand.
And so, because we put some bandage tape on it doesn't mean that issue went away, and we won't be revisiting some flavor of that. It's probably not going to be the exact same flavor, but it's going to be like a cousin of that for sure.
Do you know how many banks went out of business last year?
No, because there's always a bunch of small kind of little guys.
5.
Yeah.
5 banks.
But that's because the Fed.
3 of the biggest ever. Went out of business,
and that's because the Fed
out.
stepped in with this absolutely insane problem or insane solution, because they caused the problem to basically backstop it and to put that tape on. And I do believe, again, if there is another crisis, that they will do that again. And that's part of the thesis of what we're talking about. Because these things are all rickety, you have to say, well, what's the Fed going to do? Are they going to let the banking system collapse? Are they going to let the treasury market dysfunction? Absolutely not, people. They're not going to do that. They're going to let inflation rear its ugly head again. And that's the point. So be prepared for potentially an emergency fund and some inflation, kind of starting to peak back up again. I do think, to that point is over the long term, particularly if you have a small business, you have to look at your inelasticity of demand. Do you have the ability to continue
what does inelasticity mean for
so to continue
friends?
to raise prices? Do you have a business that is price insensitive that, no matter what happens, I would say something maybe like alcohol, right? Things are going well, people drink. Things are going poorly, people drink. They'd rather not pay for, I don't know, shower gel rather than give up their alcohol. So you want to make sure that you're in a business. If you have something that is extremely price sensitive, you need to be thinking about your exit strategy and what is this kind of continual inflation, even if it's 3, 4, 5% a year. Like in the middle class, that grinds away, that eats up real purchasing power that's very meaningful to people's lives. And so I do think, as both business owners and consumers long term, you need to be prepared for a world where, I know everyone wants to talk about a soft landing and yay, we conquered this. That ain't going to happen based on where we started this discussion, the fiscal situation. And if it does happen, it probably means something else bad happens in its place.
Right. So let's go back though, because I haven't thought a lot about this subject.
Yeah.
Not for any good reason. What would be a half a dozen businesses that are very price sensitive that you think would be vulnerable in this? Like types of business. So Midas.
I'm in a business right now. So one of the things that I do in my sort of cornucopia of things that I do is I run enthusiast programs, and we help to monetize communities and the like. And so one of my clients, is in the doll business, collectible fashion dolls. And, we've already seen it with collectors that there's a perception of value. And even if you've got inflation that increases, they still want to have the price from 5 years ago because that's how much value that they attribute to a collectible that's wearing X, Y, and Z. And so it makes it very difficult to maneuver. You can't just raise the price to $300 and go, that's what the market bears, because they're going to go, well, that's just not in my budget. This is something that I need. So things that, are not center of the plate needs, or things that are, needs that could be put to the side for some period of time, those are the things that you need to be worried about. Again, if you're a cigarette maker or a drug dealer or something like that,
discretionary
maybe not.
is the
highly discretionary
term.
Because there are some discretionary things that I think probably have a little bit more inelasticity.
Got it. Okay. So what? So let's go. Let's take this. I want to stick with a Midas shop. And we're going to get away from the vagaries of autos and EVs and all that. We're just using that as a prototypical small business. What do you think that person is? They're thinking about that business, which by the way, Midas would seem to be, fairly non-discretionary. Like your car breaks down, you gotta fix it. Like there's no there's not a lot of choices.
What I would offer is that likely somebody is going to drive, to somebody who might have been proactive when they had a little bit more discretionary income and go, the muffler's making some noises, I better get it taken care of. Okay. They're going to wait till that muffler's dragging on the floor behind them. Yeah. And so if you have all of your customer base pushing that decision out by, 3, 6 months, whatever it is, that has an impact on your business. And even if it's a 10% impact or 20% impact, that's super meaningful. And then it's always a question of, your labor costs and, how much you can charge and, the competition there. It's challenging.
Got it.
It's challenging for small businesses.
Yeah. I'm going to just shift tacks because I know we don't have a lot more time. I got 2 last things that I want to go through. You recently, I know you've been, and it makes sense given your worldview. I'm not saying I disagree with your worldview, nor that I disagree with this concept, but you've been talking more about gold. I'd love to hear your thoughts on gold, but I want to add one more piece to it. And this gets to a conversation we had last week with a gentleman named Eric Wade, who also just wrote a great book, America Against Americans, kind of very similar to You Will Own Nothing. Like they're somewhat related here. He's a very big proponent still of Bitcoin, and he's made a ton of money on crypto and been very successful, and also protected people. But what are your thoughts on gold and Bitcoin at this point?
So I am a risk-adjusted returns versus a total returns person, and And there's no doubt from a total returns, standpoint that people have made a ton of money with Bitcoin. But from a risk adjusted standpoint, that doesn't mean it's sort of a fit for everybody. I'm also someone that I only invest in things that I know really well. And I just have too many questions still about blockchain and Bitcoin, both in the areas of quantum computing, as well as what happens when all of the Bitcoin is mined. How do you pay and incentivize people to maintain that network? Because, that's the problem when something is, completely disintermediated, is that right now there's an incentive and I just don't know. So I have enough questions where I'm like, this just isn't for me. And I have these other wonderful things and a really great portfolio that I feel comfortable with. Gold, on the other hand, I understand very well. I know it has a 5,000-year social contract. I understand that central banks around the world have been loading up on it, to record levels over the past few years. And I think that it's very intentional and plays in with our thesis. When we're talking about, the discussion of the reserve currencies, and we're talking about, the Chinese yuan, part of the reason that they have been able to, get people to make trades with them is, one, that they can settle a lot in their own physical products. They're a huge exporter, so that's not an issue. But they've also been offering physical gold settlement, so that if you have a little piece and you don't want to hold the yuan, that whether it's in Shanghai or one of these other locations, that they're offering gold settlement. And I do think, instead of having this weird,
But do they keep the gold? Do they keep the gold in Shanghai? You can't send it to Memphis?
What's that? No, I think that they offer physical settlements, right? So, So, I mean, obviously, as individuals, we cannot do that. But in the trades with the countries that they're trading with, the Russias and the Irans and whoever else it is within that block, maybe Saudi Arabia, that they're offering physical tangible settlement in gold. Now, granted, that may be through a custodian, and we're not going to get into the plumbing of how you do physical gold settlement, right, between central banks, but that's just kind of what's happening. And so I do think that, just kind of doing a little bit of a fast forward, but based on sort of everything that we've laid out and the shifting of the financial world order, that there is a good thesis that, you've seen gold break out of sort of a resistance area. It's in a new area, sort of above 2,000. And I think it bodes well, kind of given the macro environment, for it to continue to be used by central banks, particularly for something like oil settlement. And if you look at, how much oil there is versus how much gold there is, there's a big disconnect there, which would kind of talk about, or point to at least, gold inflating in price. Back to my friend Luke Groman, who I mentioned before, he also pointed out, which you may have picked up in the news, I think a lot of us picked it up, but maybe didn't connect the dots, that, and by the way, Luke's somebody we're not friends, I just read his stuff, friends. But
I'm looking at the gold chart, by the way, while we're talking. That's where I was looking away.
So, if you look at somebody like JP Morgan, right, all of a sudden, Jamie Dimon comes out of nowhere and said that they want to be, the second custodian for the gold paper index, right?
Okay.
And so, so you've got this really smart guy who's really well connected, who after 18 years decides all of a sudden I want to be a gold custodian. That says different things. It could be that there's more demand from his clients, and so he just figured that he'd go down this path. It could be that there's
he's hedging his bets.
Yeah, whatever it is, right? So I feel like that's an interesting signpost. The central banks are an interesting sign. There's enough. Gold is a hedge, right? It is not something where you're earning that dividend or earning a coupon on. So you have to use it, in my opinion, as a hedge in your portfolio.
Right.
But also, if you're somebody who's worried about the worst case scenario, then you're holding physical gold, because that's a form factor you can control, and that kind of goes back to the Bitcoin thesis that if you're worried about power outages and nuclear war, like, how are you getting your Bitcoin? But I can maybe barter with some silver and some gold and whatever. Well, so there's different.
I'd rather have guns and water than the gold.
Yes, which are also other good metals and hard assets. So, but you know what I'm saying is that, like, it really depends on what your thesis is. But I do like having that in the mix as a hedge as part of a well-diversified and balanced portfolio.
So let's go to I'm going to give you your most dreaded scenario.
Oh, Jesus. Okay.
Here you go. You're at a cocktail party. You're wherever you are.
Okay. Well, we know this is not a real scenario because I would never go to a cocktail party. But okay, I'll indulge you.
You're at a cousin's place, or so maybe you wouldn't visit your cousins either. But that's
I like my cousins a lot.
There you go. And someone comes up to you and they say, Carol, what should I do with my money? Okay. Now, obviously, the first answer is going to be, well, you should hire a financial advisor.
Exactly.
Blah, blah, blah,
Enrique knows me so well, right?
No. But I got to tell you, that's everyone's answer. So it's not you.
Right.
You're not everyone. The most sophisticated money manager in the world wants to just avoid the question.
Yes.
And say, just hire money. But you can't do it. They won't give up. They say, okay, I got that. What else? You had a gun to your head. 3 things. What would you tell them to do with their money?
So I don't think that you can not be in the stock market, because I do think, over time we don't know when that question mark is going to be, and with sort of the trajectory, and I think the inflation happening, by Fed policy again, from a nominal basis, at least, to kind of keep up with inflation. I think that you probably want to have, some level in the stock market. You can rely on Enrique for the individual picks. You could do S&P 500, whatever it is that you're comfortable. But I do think that having some other hard assets, I like your friend Randy, who has productive land. That's a really good thing that has had, no matter what's happening, really steady growth. Yep. Very finite.
They ain't making more of it.
No,
they're mining for gold and they're mining Bitcoin, but they're not mining up more land.
And in some places, there's actually some really interesting tax benefits depending on what you do with it.
Yeah.
So I like that. I like people to own their own home. I think that's really important, both from an asset on your balance sheet, but also from a personal sovereignty standpoint. If you own the home, nobody can tell you what to do within the home, and that's important.
Yep.
And then, if you feel
they're going to try, but so far no luck.
Yeah, and then I feel that's where the hedges come in, is that having some non-correlated assets and things like physical gold or silver, and of course, like you said, a stock pantry with the Campbell soup, the guns, the water, the ammo, baby formula, diapers, whatever, in case of But really, that I do think diversification. I know it's like, well, you wouldn't say this anyway, and it's so boring. But there's a reason why it's boring. Warren Buffett would tell you the same thing, right? It's like
I'll take it. So you said stocks, your home, some hedges, and maybe some land.
Yeah, and if you have cash that you don't know what to do with in the interim, you're still shoving that into a T-bill or a CD or some money market product, and earning your 5% for a few months until you figure out where to deploy that. So that's where my excess cash has been deployed.
There are no wrong answers, in the sense that I just want people to answer, because I know it's like the dreaded
question.
You dreaded question, but
it's also so specific, right? So my portfolio, based on what my financial position is, going to look real different than my friends or cousins.
Here's the thing, though. Here's the thing. You go up to a doctor and you say, what should I think about my health? And that doctor has a specialty. The doctor will be like, what's going on with your health, et cetera. But despite that doctor who's been doing it for 35 years, if you really push them and they have to think about it, they can come up with some guiding principles. And too often the people that are doing things are buried in the detail of it and don't think enough about the guiding principles and how
the guiding principle is don't stick it under your mattress, because that money is being eroded. You have to put that to work somewhere.
Well, that's another one. This is why
in the short term, that's why we're in the T-bills and the CDs, and we're earning the yearly 5+%, because you can't, the people who are just sticking this in coffee cans is the worst absolute thing you can do. So I know that much for sure.
Yeah, well, there you go. Okay, well, I know that you've got something else coming up. I want to thank you for your time. We've known each other for many decades. The book is called "You Will Own Nothing." Decades, yes. You will own nothing. You can get it at your local bookstore, Amazon, etc. You have a newsletter too, which I was getting a newsletter from you before, but it's literally at the URL. Is it your name, carolroth.com?
carolroth.com/news, NEWS.
Okay.
And if you put your name on it, one went out today that we recorded it. So I can forward it to you if you would like to read it, Enrique. It was about, we covered, if you guys, this is another financial tip for anybody who went into I-bonds, which was something that when it was yielding almost 10%, I talked people in. Treasury Direct is not sending you 1099s if you cashed out of it. You have to actually go to them to print it. This is important because they know that you earn that interest and they will come after you. So make sure you go to Treasury Direct to get your 1099 if you cashed out of any I-bond. So that was one of the things we covered, yes.
There's a very specific case. So again, thank you, Carol. Appreciate your time. Safe travels, and look forward to having you back on the podcast.